Do you ever look at a stock and wonder if it's a good buy or not? I'm going to go through the process of valuing a company using a discounted cash flow model. And this is the best way to identify the intrinsic value of a stock. We're going to also look at the financial ratios at the end and compare it to its competitor. Now we're going to do Accenture. They're an IT service company, and their biggest competitor is IBM. And they have a market cap of $130.45 billion. So we'll put that into the model, and they're trading at 204.56. So now that we have the shares outstanding, because it's a market cap divided by stock price, gives us the shares outstanding. Next, we need to calculate the free cash flow, and that's how you identify the intrinsic value of a company. You estimate the future free cash flows of the company, then you discount it back to today, and that gives you the intrinsic value of the company. You divide that number by the shares outstanding, and that gives you the intrinsic stock price. And free cash flow is the best indicator of the health of a company, because that's the actual cash that's left over after operating a business. Next, we're going to look at the income statement and get net income. That's the profit and loss. And we're going to put that into the model. And then last, we'll take the revenue, which is the sales for each year. And you want to make sure these numbers are fairly consistent and positive, because if you don't have one of those two, it can make it really hard to value a company. Next, we need to figure out the discount rate of the company, and they have pretty much no debt, maybe a few $1 million. So it's pretty much 0% debt. So we're not going to even put debt into the model. But let's put their beta in. They have a beta of 1.05. So the stock moves pretty much with the market. So we calculated the weighted average cost of capital by using the capital asset pricing model. And we came out to 10.4%. And that's what we're going to discount the future cash flows by. And let's see what we get. So we calculated 4 years of future free cash flows. We did a terminal value, which is all years past year 4. We discounted those numbers back to today using the WACC. And the value of the company is $120 billion. And when we divide that by 638 million shares, we get a stock price of $189. It's trading at 205. So it's a sell according to the model. It's trading at an 8% premium. So let's look at the stock price historically. So it looks like it was trading below intrinsic value, below 188 a couple months ago, or even a month ago. But then it's come back up. So it's trading pretty close to intrinsic value. Let's see what Simply Wall Street values a company at. They value it at 160. So a little lower than what I value at. So the stock price can totally move however the market perceives this company. If the company is perceived really highly amongst investors, people are going to buy the stock and the price will keep going up because people will bid higher and higher for a price to buy it at. And if people think the company is going to perform poorly in the future, they're going to sell their stock or not buy the stock, and that pushes the stock price down. So a lot of factors can go into the stock price. Fundamental factors of what we looked at, and there's also technical factors and market sentiments. So it's a lot of things, a lot of psychology that goes in the market, and that's what you have to understand as an investor. But if you really think this is a great stock, you just buy it and hold long term. Even if it goes up or down, just ride it out. Let's look at their financial ratios. So we need some more information. Let's go back to the balance sheet and get their current assets. These are cash, accounts receivable, and inventory current assets. Assets that can be easily liquidated into cash within 12 months. And that's $15 billion. And let's get their current liabilities. These are liabilities and debts that are due within 12 months. So they don't have any debt, so it's probably mostly accounts payable. And the equity is the total assets minus total liabilities. And that's $14 billion. Let's see their operating income, or EBIT, earnings before interest and taxes. And that's how much money they generate from their regular operational business, $7 billion. So you can see they also have to pay taxes and interest expense, which is almost nothing. So the net income comes out to $4.8 billion. It's mostly in taxes, what they paid. So let's look at their ratios. The PE is a little higher than what I want. I like to see under 15. But we have to make sure to compare it to IBM to see how it stands up. Price to sales is okay. I prefer under 2.2. They have 3.0. Price to book seems a little high. I prefer under 3.3. They have 9.1. Price to book is stock price over book value per share. So book value is equity. So it's equity over the shares outstanding. Current ratio is good. I like to see 1.2 and 2. This is your current assets, how much they can cover your current liabilities, your current debts. ROE seems pretty good, 33%. That's strong. And they have no interest, so there's nothing to cover there. So let's look how they stack up against IBM. IBM has a much better PE, 11 compared to their 27. Better price to sales, better price to book. So IBM looks like it has much better ratios. Current ratio, they're both in good shape. They both have at least 1. IBM has a better return to its investors of 45% compared to 33%. But ACN has 0% debt, IBM has 75% debt. That just shows you when you take on debt, you can make your ratios look really good, because if you borrow money, then you can use that money to buy new products, invest in other businesses, and that adds revenue. And debt doesn't really affect your bottom line except the interest expense on the debt, and which is usually minimal compared to how much you borrowed. So it's something to think about when investing in a company. And the market cap, Accenture is actually bigger than IBM. They're 130 billion in market cap. IBM is 110 billion. So it's hard to really compare, because one company is debt-free and other companies is levered up. So IBM looks great in their ratios just because they have so much debt. I'm sure if Accenture took on all that debt, they could probably improve their ratios as well. So let me know what you think in the comments. This is a really interesting company to look at and compare to IBM. Thanks for watching.